You heard it from Lauren. Stocks on a tear this year, setting record after record. But can equities keep the momentum going into 2014? Let's kick off our first showdown with Mike Chadwick, CEO of Chadwick Financial Advisors, and Scott Martin, United Advisors Chief Market Strategist, and, of course, a Fox News contributor. Scott, I want to start with you. You say that we're heading for Dow 20,000, and you're going to make the hats. Based on what?
Based on the fact I already have them in possession. You know, Cheryl, listen, it's one of those things out there that you need to look at when you're considering valuation. I mean, I'm not going to say that the market is necessarily cheap here. I don't think it's expensive, say, on an absolute or resolute term, but it's cheap versus other assets. And that's the whole thing. If you're a pile of cash that is walking down the street, imagine that. That's a really cool image. You're going to go one of, say, three places. You're going to go into bonds. You're going to go into commodities. And both of those things have been smoked in 2013. You don't want to go anywhere near those, or you're going to go to the equity party, being New Year's Eve. And that's where people are going to go. That's where that pile of cash is going to go. There's a lot of retail money on the sidelines. There's a lot of doubters, non-believers. That's going to keep this market going until people are convinced.
Mike, you're not a believer at all. In fact, I don't know what you're going to be doing tonight. If he's at the equity party, Mike, where are you going to be tonight? Because you don't like stocks in 2014.
Well, I'm going to be at a party, but I'm also going to be very cautious with how I deploy assets. I disagree on the valuation metrics. Stocks are expensive, and people are buying them. As he pointed out, there are not a lot of great alternatives out there. So I think people are behaving on an emotional level. They're chasing what's working right now. But from a valuation perspective, I'm very, very cautious. Whenever we've reached these valuation levels historically, it's been pretty ugly moving forward.
All right. Let Scott respond to that. Pretty ugly going forward. I mean, what are the returns we have for 2013?
They're very good. I mean, look, you know, pick your favorite index. I mean, it was mentioned in the previous segment. Nicole mentioned it. I mean, there's great. I mean, you look at the NASDAQ, the tech sector, that's up some 30+%. Some of the industrials are up 28. Pharma, which we've talked about all year, Cheryl, up 30-some%. I mean, this is a broad-based rally. And the other thing about the valuation is what? I mean, versus trailing or versus future earnings, depending on how you look at it, we're in the mid-teens. That's not necessarily expensive. If you look back to the 90s, it was way more than that. If you look back to 07, it was way more than that. And oh, by the way, your bond portfolio, which is in your balance, say, allocation, is way overvalued. It rates down at 1.5% now. They've doubled, and they're only at 3%. And you're telling me somebody's going to go out there and choose bonds instead of stocks? I don't think so.
Mike, what do you say to that? I mean, he's got a really good point. You got to respond.
No, I agree with the bond. I agree with the bond argument 100%. I absolutely wouldn't be chasing bonds. I would argue today a lot of things are expensive. We're essentially in a global asset bubble. Bonds are expensive. Stocks are expensive. Commodities are not expensive. Commodities have actually gotten beaten up, but we wonder why, with all this money printing going on across the world, why are gold, silver, all the metals doing super well? They should be doing really, really well. Now, to his point, in 09, in 07 and 99, things were more expensive, but today, things cannot be considered cheap on any metric. Another thing of note, corporate profits as a percentage of GDP today are as high as they have ever been. This is great for today. Last year was a wonderful year. This is not sustainable, not even close.
Well, then, Mike, what's your concern here? I mean, if you're pointing out to really good things, corporate profits looking really strong in 2013, especially as we go into the final quarter. So what's your worry here about 2014? Well, what's going to take the party off the rail?
I'll tell you what, I don't know exactly what takes the party off the rail, but here's my concern. Corporate profits are really, really high from a historic perspective. On average, corporate profits have been 6% of GDP. They're almost double that right now. They're not sustainable. See, corporations have been doing a great job with cutting their expenses. They're cutting their people. They're cutting their costs. They're moving jobs and production overseas. Their profits look strong right now, but there's only so much you can cut. I think they've cut to the bone. Without a lot of top-line growth, how are you going to get increasing profits year over year?
Scott, he's making a strong point there that companies have been making, you know, the numbers they have been making in the last few quarters because they've been cutting back on employees. Good point. Respond.
Fair point. We'll give him one there. It's a fair point, Cheryl. But also, corporate balance sheets are healthier than they've ever been. I mean, that's the other thing is like corporate profits are up, but they're also doing great jobs on the balance sheets and the bottom line. I mean, look at the financials. You know, Cheryl, an Ariel that I have hated for years have convinced me to buy them because their balance sheets look actually pretty robust right now. And that's the other thing. I mean, going forward, if you're looking at corporations, the cycle is starting. Actually, what's happening is they're pulling out of what Mike was talking about, which is they're cutting the bone. and they're not anymore. They're actually starting to hire and spend money on CapEx, R&D. That's going to lead us into these next couple of years as hiring comes back, and actually wages might even rise, therefore sparking some inflation, which on the early cycle is good for real assets.
Okay, well, Mike, his point is good that we are seeing some wage growth.
We're seeing a little bit of wage growth. You know what happened? In the high end, the ultra-wealthy consumer is doing great. The consumer who's really struggling is the middle class. And obviously, we all know it's shrinking. We're not going to see a big boom in our economy because our economy is based 70% on the consumer spending. And consumers are tapped out. Corporations are in good shape. This year, corporations have done a lot of refinancing with loans. Now, there's another thing to think about. The loans today. Corporations have been refinancing at these great rates. The rates are ultra low across the board. They cannot stay here. You know, we're in a good equity environment. Asset prices are high. This is mainly due to easy money policies, and easy money policies never last long, and they never prove out well. What did easy money do to the housing market? What does easy money do when you give it to a teenage kid? They don't behave responsibly. This easy money party does not end well, not even close.
So we're going to have to all gather back in 1 year, and we're going to see who's right. Scott's over here saying down 20K, and Mike, you're over here saying, you know, forget it. This is going to be a big fall in 2014. One of you is right. That's the great news about this segment. Guys, thank you very much. Happy New Year, by the way.
Happy New Year. Thanks for having me.
All right. Bye, Mike. Bye, Scott.